I think we're just going to now have the first higher low in a recovery. Silver, though, on the other hand, I told everybody last week, I said, I would not be surprised to see a double bottom. There's a lot over just even the last 6 months, a lot of either support or resistance at 29.50. That's kind of where I think we're headed. We got to 29.71 back on the 14th. I wouldn't be surprised if we head down somewhere between 29 and 30 again, just to freak everybody out. And then you get in a rally. The economic data, I suspect in December will not be as strong as it was.
In today's news recap, a sharp fall in the price of silver has created a buying opportunity for investors, following a metal which has better fundamental appeal than its richer sister, gold. The fall of 12.1% over the past 4 weeks by silver is double a 6.3% drop in the price of gold. Both precious metals have been sold off after reports of a ceasefire in Lebanon and the choice of investment professional Scott Bessent as U.S. Treasury Secretary. Gold and silver are classic counter-cyclical investments, rising in times of economic and political instability and falling in stable conditions. But the latest moves have seen silver treated more harshly than gold, with its fall from $344 an ounce at the end of October to $30.29, easily outstripping gold's decline from $2,786 to $2,611. A bounce back by silver to around $33 seems likely, with that price tipped by Morgan Stanley and Investment Bank as the target for the second quarter of next year. Strong industrial demand, especially from the electronics sector, is the factor likely to see silver outperform gold next year. Don't forget about silver's PV boom. Whereas only 10% of gold is consumed by industry, an estimated 55% of silver goes into products such as solar panels and photovoltaics, where demand grew by 33% last year and 64% this year. Adding to the appeal of silver is a big market deficit, which started to open 5 years ago and has steadily widened. The shortfall in fresh mine supply is being met by a drawdown in above-ground stocks. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button and check our pinned comment for a massive Black Friday deal. This is your chance to lock in ultimate online security with NordVPN. This is especially for you stackers out there browsing for precious metals info and making sizable investments. Keep your data safe, stay anonymous, and grab this exclusive offer. 3 extra months free plus a 30-day money-back guarantee. Don't miss out.
Yes, and we started talking about this at my TF Metals Report site. I think Thursday of last week, I was really pleased to see the recovery from that almost hysterical trade post the election. And we can probably talk about what I mean about that in a minute. But, you know, gold and silver just got smashed for about 6 or 7 days after the U.S. election. And we had a nice recovery last week. But by Thursday of last week, I started warning everybody on my site, you know, we got all these expirations looming, okay? They were not just going straight back up to 2,800 in gold from here. Just because, I mean, we've seen this hundreds of times before, and now we're getting it today. My expectation, again, I told everybody this last week, I think gold had moved far enough. It was up $130 last week, up every single day last week. It moved far enough that I don't expect gold to make a lower low relative to those kind of washout lows back on Thursday, I got to do the math, 14th. We got down to 25.41 early that morning. I'd be really surprised if we got down that far. The momentum indicators were so washed out that morning that even if we did trade down to, you pick it, 25.25, you'd have what the technicians call a positively divergent low where price goes lower, but the momentum isn't nearly as bad. So that would be a low. But again, I don't think we're going to go that far. I mean, that's another, I don't know, $70, $80 down from here. I think we're just going to now have the first higher low in a recovery. Silver, though, on the other hand, I told everybody last week, I said, I would not be surprised to see a double bottom. There's a lot over just even the last 6 months, a lot of either support or resistance at 29.50. That's kind of where I think we're headed. We got to 29.71 back on the 14th. I wouldn't be surprised if we head down somewhere between 29 and 30 again, just to freak everybody out. And then you get in a rally. The economic data, I suspect in December will not be as strong as it was prior to the election last month. in all the other months so far this year. December seasonally is a very strong month, Elijah. We haven't had a down December, I think, since 2016. Beginning in 2017, we've been up every single December. It was only 1.5% last December, but the average 2017 through 2022 was about 4%. And we all know January is usually a good time as well. So again, started thinking that we probably going to pull back this week due to all these COMEX shenanigans. But I think then to finally answer your question, I think we rally in large part through the month of December. We finish up what is just a fantastic year, especially in gold. And then we look.
In today's news recap, higher supplies to the UK lifted Swiss October gold exports. Gold exports from Switzerland rose in October compared to September due to higher supplies to Britain, but they were down from a year ago as high gold prices kept deliveries to China and Hong Kong subdued. Swiss customs data showed on Tuesday that supplies from Switzerland, the world's biggest bullion refining and transit hub, to Britain in October, reached the highest level since June 2021, according to the data. London is the world's largest center for over-the-counter trading of gold. This year's 27% gold price rally, which took spot prices to a record high of $2,790.15 per troy ounce on October 31st, has been affecting physical demand in China, the world's top consumer of the metal. However, gold exports from Switzerland to India, the world's second-largest gold consumer and a major importer, rose in October from September amid festival purchases.
And I remember I mentioned earlier this hysteria that I felt after Trump won, as if all the market was attempting to price in, that, the economy is going to be so great and Musk is going to cut the budget deficit in half, and because the economy is so great, inflation is going to actually come back, so the Fed won't be able to cut and all this stuff. And I'm not buying it. One, it's Washington. Okay, we got to be a little more realistic about how things move, and unless somehow, I don't know. I don't think there's a line item veto out there. Hell, the U.S. hadn't even had a budget. I mean, it's just been all nothing but appropriations bills and omnibus spending packages for the last decade. So how's that going to work? Are they going to, suggest $300 billion in spending cuts? And if they do, will that actually happen? Musk can't just, wave a pen, and neither can Trump. So I'm not sure that happens. But then even if you boil it down even further, Elijah, if you were to look at GDP growth, just the government statistics, not the, we know real GDP should be lower because inflation is actually higher than they report, just the straight up numbers, 3%. In this most current year, and you put those into nominal dollars, it almost equates perfectly to the amount of deficit spending in the last fiscal year. So any reduction in government spending is going to bring with it a really almost a dollar for dollar reduction in GDP. And that means not necessarily dollar for dollar, but a reduction of income to the government. Okay, so if the economy slows because government spending slows, so then all of a sudden tax revenues fall. So you could theoretically cut spending by $300 billion, but because tax revenue to the government slows and falls by $300 billion, your net deficit's the same. So then you can talk about the math being the math and over $1 trillion in interest expense and all that kind of stuff. Look. That's what I mean. It was all kind of a hysteria those 6 or 7 days after. I don't think it was realistic. That's why you.
The discussion focuses on the recent price movements in gold and silver, highlighting potential recovery patterns. While gold has shown resilience with a higher low in its recovery, silver may form a double bottom around $29 to $30 before rebounding. Factors driving silver's outlook include strong industrial demand, particularly in solar and electronics, and a widening market deficit due to reduced mine supply. The script notes the cyclical nature of precious metals as counter-cyclical investments, often rising during instability, and falling during stable conditions. It predicts a potential rally in December for both metals, with silver possibly closing at its highest annual price, setting the stage for a bullish 2024. Economic uncertainty, government spending issues, and historical performance trends underline the long-term bullish case for precious metals. Silver's unique industrial demand and tighter supply dynamics make it a standout among commodities.